If you're just starting out with investing, there's this one question that can feel, well, super overwhelming.
So what's the absolute best way for a beginner to invest, say, $100? Well, today, we're going to answer that by digging into this really cool 4-year experiment where someone did just that. They put $100 into 5 totally different investments, and we're going to see exactly what happened.
All right, so here are the 5 contenders in our little challenge. We've got individual stocks, real estate, crypto, gold, and of course, index funds. For each one, we're going to break it down using the same scorecard. Things like how hard is it to learn, how risky is it, and then we'll get to the good part, how that $100 actually did over 4 long years.
Okay, first up to the plate, individual stock picking. This is probably what most people think of when they hear investing, right? You're basically buying a tiny slice of a company that you think is going to do great.
Now, when it comes to individual stocks, there's a big trade-off you got to know about. The learning curve, it's steep. The risk, yeah, it's high. You've got to dig into company financials, and look, if that one company you bet on goes belly up, your money could be gone. But on the flip side, you've got some pretty sweet perks, like solid passive income potential from dividends and some really great tax advantages if you use the right accounts.
So, the big question, how did our $100 do? Well, to make this experiment a true test of luck and risk, the stock wasn't carefully chosen. Nope, it was picked by literally throwing a dart at a list of company names. And where did that dart land? Samsung. So after 4 years, what do you think happened? Oof! The result? A measly $67.72. And yeah, that includes a tiny 10 cents in dividends. So this investment actually lost almost a third of its value. Not a great start.
That's a negative return of more than 32%. It's just a perfect example of how picking one stock can be a complete and total roll of the dice.
But hang on. What if that dart had just landed a little differently? What if luck had been on our side? If that same dart had Microsoft, that $100 would have turned into $188. And get this, if it had landed on NVIDIA, an absolutely staggering $980. It just goes to show you, the upside can be massive, but man, so is the gamble. All right, moving on. Next, we're going to look at a couple of what you might call tangible assets, real estate and gold. We'll kick things off with a really modern way to get into property investing, using something called a real estate investment trust, or you'll hear it called a REIT. Now, I know REIT sounds kind of technical and complicated, but the idea behind it is actually super simple. Just imagine you and a few friends pool your cash to buy a rental property. You'd all share the rent money, right? Well, a REIT is just that, but on a massive scale. We're talking thousands of people investing in huge properties like office buildings and shopping malls. So, REITs are usually seen as a bit safer than just buying one stock. The learning curve is kind of in the middle and the risk is medium. But here's their real superpower, passive income. By law, they have to pay out most of their profits to shareholders as dividends. That means you get a nice, steady stream of cash coming in.
So, how did our REIT do after 4 years? The $100 is now worth $101.52. Now, what's really interesting here is that the value of the investment itself actually went down a little bit, but it paid out almost $12 in dividends, and that passive income was just enough to push the whole thing into a tiny profit.
Okay, on to our other tangible asset, gold. This one's been around forever. For thousands of years, people have seen it as a safe haven, a way to protect your money when the economy gets a little shaky. Gold's scorecard is pretty interesting. It's easy to buy, so the learning curve is super low. But look at that passive income rating, 0. A big fat 0. That's because gold doesn't do anything. It doesn't make products or earn profits. Its one and only job is to just sit there and hopefully hold its value. So how did it do? Well, our $100 in a gold ETF grew to $140.10. That's a really solid 40% return. It's not going to blow your mind, but it's a great example of how gold can give you that steady, reliable growth and just protect the value of your cash. All right. Brace yourselves, now it's time for our most volatile, most controversial contender of them all, cryptocurrency. And for this experiment, the $100 went straight into the OG, the king of crypto, Bitcoin. Just look at this scorecard. It screams high risk, high reward. The risk level is very high for a reason. Prices can swing like you wouldn't believe. And tax efficiency, it's poor, because you can't usually stash it in those nice tax-friendly accounts. We are firmly in speculative territory here, folks. So, with a very high risk level like that,
This is the one everybody wants to know about, right? After 4 years of just insane ups and downs, where did that $100 in Bitcoin end up?
It ended up at an incredible $652.24. That is a return of over 550%. But, and I cannot stress this enough, this is so critical. This kind of performance is a wild outlier. It's not normal. For every single crypto story like this, there are tons of stories of people losing everything.
Okay, let's bring it back down to earth for our final contender, one that a ton of experts recommend, especially for beginners: index funds. The whole idea here is to stop trying to pick one winning stock and just invest in the entire market instead. And this is the perfect way to think about it. It's like buying a basket of stocks. Instead of just buying, say, Apple, you're buying a pre-made basket that has a tiny piece of hundreds of the biggest companies out there. You're not betting on one horse to win the race, you're betting on the race itself.
So, as you can see, the scorecard here is pretty much the polar opposite of picking a single stock or diving into crypto. The learning curve is low, the risk is low, and that's all thanks to diversification. It's simple, it's been historically safe if you stick with it, and yeah, it's super tax efficient.
And the results speak for themselves. The $100 invested in an S&P 500 index fund grew to $179.57. That's almost an 80% return. Now look, it's not the mind-blowing explosion we saw with crypto, but it's strong, it's consistent, and you get there with way, way less risk. And that's exactly why so many long-term investors love it.
So, after 4 years, after all that, how did our 5 contenders really stack up against each other? It's time for the final showdown.
And here it is, all laid out. The final numbers are just all over the place. You've got everything from a 32% loss with our random stock pick all the way up to that crazy 552% gain from Bitcoin. And right there in the middle, you have gold and the index fund delivering those nice, strong, steady returns.
When you see it like this, visually, the difference is just, whoa, it's staggering. I mean, yes, Bitcoin's growth was absolutely incredible, but remember the massive risk that came with it. And then you have the index fund, which quietly delivered the second best return of the bunch. It really proved to be a powerful engine for growth, just with a whole lot more consistency.
So, what's the real takeaway here? It's definitely not just go buy Bitcoin. The most important lesson is that no matter which of these paths you choose, just starting, even with $100, is what really matters. Time is your absolute best friend in investing. That power of compounding is what turns these small beginnings into some really significant money down the road.
So, now that you've seen the results of this whole experiment, the real question isn't which one won. The question you should be asking is, which one is right for me? Your first $100 is all about figuring out your own goals and how much risk you're comfortable with. Because really, the only wrong choice here is to not get started at all.